Good afternoon, and welcome to Business Review, your trusted source for comprehensive coverage of today's business updates. In 1696, King William I of England introduced a revolutionary new tax to raise state revenues. Every household would pay a levy based on the number of windows in their home. The idea was that larger homes, typically owned by wealthier individuals, would contribute more. However, despite its progressive intentions, the tax failed to generate the expected revenue. Many people boarded up their windows to reduce their tax liability. Over time, this policy backfired, as the lack of ventilation contributed to the spread of diseases such as typhus, smallpox, and cholera, posing significant public health challenges for the state. We have Anthony reporting on this.
India's finance minister, Nirmala Sitharaman, introduced a measure aimed at broadening the tax base. In her seventh budget, she announced a 60% increase in the tax on trading futures and options, raising it to 0.02% and 0.1% respectively. Additionally, the capital gains tax for stock market investors who cash in within a year was increased from 15% to 20%, while long-term investors will now pay a rate of 12.5% on gains, up from 10%. India's finance ministry, drawing inspiration from 17th-century England, hopes that these changes will prompt a behavioral shift and curb the unchecked explosion in the derivatives market, where retail investors make up 41% of total trading volumes. However, the government might face a challenge if traders try to reduce their tax burden rather than moving away from speculative activities, which can have unintended negative consequences. So far, the tax hikes have overshadowed the budget's positive aspects. In the 2 days following the announcement, foreign investors liquidated nearly $1 billion worth of Indian equities, and stock prices have continued to fall. The lack of populist spending aligns with our expectations, although the capital gains tax increase for equities goes against our expectation of no change, said Upasana Chakra, chief India economist at Morgan Stanley, in a note to clients immediately after the budget was unveiled. Will the government achieve its goal through this levy, despite the initial pain for investors? This rise in short-term capital gains tax from 15% to 20% will discourage excessive trading activities, while the hike in long-term capital gains taxes from 10% to 12.5% is sentimentally negative for the market in the near term, said Siddhartha Khemka, head of retail research at broker Motilal Oswal. Not everyone is convinced. It may help to reduce some of the speculative nature of the market, but is unlikely to deter retail investors significantly, said Michael Langham, emerging markets economist at UK-headquartered asset manager Adbrin. This move is part of broader regulatory efforts to mitigate financial stability risks in the equity markets, and further measures to curb retail investor risks could follow. The risk for regulators might find a parallel in modern Britain's experience, where similar measures have sometimes led to unintended consequences. Back to you, Bella.
Thanks for that update.
Thanks for tuning in to Business Review for your daily dose of business updates. Don't forget to hit that subscribe button and turn on notifications so you never miss out on breaking stories and insightful analysis.